down the hammer and pick up the pencil. You're about to listen to the Savvy Radio Show. Learn from real-life real estate investors, experience revealed with the Savvy Landlord as your host.
Anyway, my name is Steven Van Kellenberg. I am the Savvy Landlord. I buy houses, I sell houses, anything revolves around real estate. But I'm not here today to speak. My man, Scott McLean. If you don't know Red Dirt Lending, he's been around for as long as I've been around as a real estate investor. I actually, where your office is, I did one of my very first deals in 1999 in that building that you're in. I tried to buy that building before he bought it.
Oh, wow.
Yep, R.D. Smith and Scott Smith. I signed that was my first table closing. Don't ever do that. You get no title insurance, but I was a good transaction. I'm just saying, I signed my deal there. But superstar hard money lender, right? Basically is your main thrust. You're also a buy and hold investor. He's been an investor for a long time. He's going to share a story how he got to where he's at today. His claim to fame, he's real humble about it, but he has access to over 7 million, 10 million of lines of credit, which is pretty cool. It takes a lot to get lines of credit, and he rents that money out. He's going to go into that. He's going to share about 10 or 15 minutes about who he is, and then we're going to drill him with questions. There is a piece of paper in front of you. If you are new, Alexis, it's Alexia, right? Alexis, do not be shy. The more questions you ask, there is no novice question. I used to say dumb because that sounds kind of weird, or all questions are great. I think when you bring a question to the table, it only motivates someone else to think of a question, and I think that's how we learn. We've been corrupted with school, where you're not worthy enough because you don't know something. First of all, I think you're the smartest people to be here. There's millions of dollars in this room. I don't know how many, but we already know that Scott has access to 7 million. There's probably $30-40 million in this room, and why not learn from somebody else that's already died once? I'm excited to have Scott speak. I'm the one that books the speakers. And, this is not a profit-making machine. We just put this together to have an opportunity to connect with each other and to learn. I know that I'm going to learn some nuggets, and I hope that you would write down questions and ask Scott. He's very open and very genuine, and it's just an honor to have you here, Scott. Please welcome Scott McLean.
Thank you very much. Don't do a whole lot of speaking, so forgive me if I'm not very good at it. I thought it might be a good idea to share with you a little bit about my history, tell you where I came from, and then I'll tell you why Stephen thinks I'm qualified to talk to you. First of all, I've seen a lot of speakers at a lot of real estate meetings, and 95% of them are kind of a rags to riches story. Mine is actually in reverse. I was really riches to rags story in the sense that I was born into a very prominent family here in Oklahoma City. And I had a dad who was willing to back us on anything we wanted to do. And that included lending all of his kids money, which is a really, really dumb idea. I highly recommend you don't lend your kids money because it screws them up. We had a lot of success early on. We did real estate wise. We flipped the Union Plaza building on Northwest Expressway, east of Baptist Hospital. I don't know what it's called now, but made a great amount of money on that. We owned In Cahoots nightclub, the Country and Western nightclub, for 12 years. We put in...
I've been there.
Yeah. We had, most notably, my dad owned and operated a candy company, Bunty Candy Company, in what's now called Bricktown, for 30 years. Sold it in 1991. The buyers of the property didn't want the real estate. Turned out to be Bricktown. So we put in the Bricktown Brewery 21 years ago, this October. And of course, you all know what happened with Bricktown. We sold it, got a great number for that. We've had lots of successes in real estate, but we've had even more failures in little operating companies that we got involved in. Everything from trash compactor manufacturing business to literally a company that you buy a token at the pro shop, and if you got a hole in one, you'd win $1 million. I don't know why we invested in that. Nobody got the $1 million, but the company lost everything. So we had a string of losers on operating companies that we went through, and just the combination of five. I'm one of 5 sons who worked for my dad, so there are 6 of us all together, and a bad arrangement, very spoiled. At 25 years old, I was making $108,000 a year, and I really wasn't doing that much, to be honest with you. And family businesses being what they are, and human nature being what it is, things broke down. So we also got into houses in 2002. My brother Rich bought the first house, said, you really need to get into buying houses. And so I did, and I liked it. And as all of you know, once it gets in your blood, you're kind of screwed, right? You'll do it forever. So in late 2002, I said, well, if we're going to do this, let's go ahead and do what looks to be the best brand out there, which is HomeVestors, the We Buy Ugly Houses thing. So we bought a HomeVestors franchise in 2003. In the next 4 years, my 2 brothers and I now, because 2 of the other 2 brothers, we redeemed their shares, and they figured out the family business wasn't going to work before we did. And they left, and we bought, I think, 400 houses over that 4 years. It was crazy. We just wholesale. We did some fix and flip, but we were very bad at it. We held some only because we paid too much for them. We made a lot of mistakes. And so I was disenchanted with that and decided there was a franchise in Houston who was doing hard money. And I cozied up to him at one of the conventions and basically just copied his model and started Red Dirt Lending February 2007. Great success with that. We've done over 500 loans in the last 10 years, which is somewhere in the neighborhood of $70 million on the street. But as Stephen pointed out, it's really the same 6 or 7 kept going out and coming in several times. So I know a lot about hard money lending. We also, as a result of the early days, we took some houses back that we didn't really want and found myself with 19 houses as just pure rentals, which I actually don't really like that much. I prefer a lease option strategy, and I'm not here today to talk about that. But I basically converted those 19 houses into lease options, and then liked that business so well that I decided to go out and started buying houses again to add to that fleet. So my brother called me in July and said there's a HomeVestors franchisee a local HomeVestors franchisee that's struggling. You want to buy it? I said sure. So I bought it, and it was a good price and what have you. But so as of September 1st, I started the HomeVestors franchise again for my second tour of duty, and am enjoying it very much. Actually, it's a good company, and I've probably about 12 houses since September. Good leads, very high quality leads, but it's a lot of work like everything else. So it's no free lunch, that's for sure. So anyway, I'm now up to 44 rentals, and I say that lease option deals rather. Just to tell you that I've got experience in commercial real estate early on with the family. I've got experience with buying houses, of course, and wholesaling them. I've got experience with hard money, obviously, and then also operating a lease option fleet. So odds are I might be able to answer your question if when we get to that point. What else can I tell you about us? Oh, just you can tell there's some disdain about family business as I'm talking about this. I literally was convinced, and on paper, it looked as if I was worth well over $1 million when I was 30 years old, but turned out the paper was wrong.
Oh, no.
And over the next several years, just some incredible things happened, and I actually kind of had to start over at about 2009.
Wow.
And so, however, I have to give it to my dad. He stepped up again and loaned me a couple $100,000 to try to do some hard money. We got some traction on that, got a bank line, and it rolled from there. And he's made a lot of money since that investment, so he's happy with that. But let me see. Did I leave anything out?
No, you're doing good. I got good questions. Keep going.
Okay. And so...
Well, walk us through the hard money process, or
Sure.
How does it work? Someone calls you, or
So starting out, we have a one-time $100 fee, and that is to open the file. We do run your credit. There are hard money lenders in town, including my brother, Rich. He's also a hard money lender, and they're all different. Rich is more focused on those 700 credit score and up kind of people. I am under that. I really don't care. I do care what your credit is. We do run your credit. However, we're really more looking at what's the quality of the deal? How cheaply are you buying the property? And do you know what you're doing? What experience do you have in flipping houses? In the early days, we did some hard money lending for landlords to tie up a property and then roll us out in 6 months when they get it fixed up, tenanted, it's seasoned a little, and financed us out. That didn't happen for about 8 years because it was so hard to get a loan, but now that's coming back. So we're starting to see some landlord guys use us as a way to lock up a property and get done what they need to get done. But 90% are flippers. 90% of our customers are flippers. And you have to buy it in a legal entity. We don't want to be in any way, shape, or form looking like it's a consumer loan. We only lend on non-owner-occupant properties. We make you buy it in a legal entity. If you don't have one, we make you form one. It's, like I said, a $100 one-time fee to get started. After that process, you can call us for pre-approval letters if you want to utilize that in submitting your offers. And then once you find a property, at least here in Oklahoma City for now, it's $300 for a property analysis. That's where we send our guy out. We get you to fill out what we call a RIB sheet, Retail Improvement Budget Sheet. And that tells us what you're going to do to the property. So now we know the scope of work that you're going to do to the property, and you assign the values to that of what you think it's going to cost to do that. We then send our inspector out to analyze the property, not only from comparables of recently rehabbed properties in that neighborhood, but also to look at the repairs. Look at what you think you're going to do, what you're going to do to the property, what you think it's going to cost, and then we put what we think it's going to cost, and we use our numbers. But it also helps us understand how well you know what you're doing. You know what things cost, and do you know what needs to be done to this property? Do you know what it costs to do it to that property? And from that, we come back with an analysis showing you what we're prepared to lend on the property. And typically, starting out, we were at 16.9 annualized interest, 5 points, and 6-month loans. So it was a.
That's right now?
No.
Okay.
No, times have changed.
I hope so.
Definitely changed. And also, as a result of having success in Oklahoma City, just a year after we started lending in Tulsa, and then we made a big jump up to Minneapolis, St. Paul, believe it or not. We did that because that market appeared to us to be ideal. We wanted a market that was at least twice the size of Oklahoma City population-wise, and there were a bunch of other screens which helped us pick that market. But anyway, it turns out we got very, very fortunate. We actually made our first loan February of 2009, which was the bottom of the Minneapolis-St. Paul market. So we came in with fresh capital when all the other hard money lenders were nursing their inventories. And so we were able to hit the ground running, and by simply doing what we said we would do, we had a big part of the market share quickly, and that's a big reason for our success, really. Most of our loans have been done in Minnesota, not in Oklahoma. And so now that market has cooled, our volume is way down. And it will pick back up again. But we're doing some loans in Oklahoma, but our volume is pretty low right now. The big reason for that is a good example of why, especially in Minnesota, is everybody and their uncle now knows that the real estate market has recovered from 10, 11, 12. And there's a lot of newbies in the business, and they're driving up prices. My regular customers can't find deals as easily as they used to. And so it's natural that the volume would be down. So, and then, let's see about the process. So, one-time fee, then your property analysis fee. The rates. So, as a result of the market changing, we've come down on rates a few times. Most recently, we're at 14.5 and 4 points. For loyalty customers, 13.5 and 3.5, I believe. But we're just... and now as a result of the success we're having with the lease option fleet here in Oklahoma City. Now, I don't do that anywhere else but Oklahoma City. Okay, those 44 properties we had all central Oklahoma, not even in Tulsa. We really want to grow that. As a matter of fact, I recently joined up with a partner out of Texas who wants to build a very, very large fleet of lease option properties. And so I told him I can help you with that. And so I'm madly out there trying to buy houses for him, of which I get a piece of. So he's got my heart and mind nearby. And so that's the plan. So we're really... we're not retreating from hard money, but we are altering the model. And I wouldn't say that we won't lend on repair money if you have experience. Certainly, if you're an existing customer who's paid us off on a few loans. But if you can prove that the deal is good enough, we can still do that. But honestly, we're just about to send out an email and announce 12% annualized return, which is you don't find very often in hard money. 2 points in a 12-month loan. But it's acquisition only. That's the catch. In other words, we won't lend repair funds post-closing. It's up to you to find the repair money. Now, we don't care if you go to Stephen or other money guys and get the $25,000 of repair funds and pay him 25%. It doesn't matter. With our 12% on the big piece, your overall interest rate's going to be something that you can handle. We don't care if you get it from a rich uncle or a second mortgage guy, or it doesn't matter to us. But we want to make sure you have the money. And the way we're going to do that is we're going to make you put half of those repair funds up. So we'll escrow that in our trust account. So if it's a $25,000 rehab budget, you got to bring $12,500, right? And then when you're done with half the repairs, you call us. Our inspector goes out. As long as the work's done, we release the $12,500 to you. What we don't want is to have you inventory properties using our 12% money and not do any of the repairs. We simply can't do that because that leads to trouble for both you and us. In addition to that, you have to bring the 6 months of prepaid interest. So we don't have a collections problem and you don't have to write us checks every month. So if it's a $100,000 loan on 12% interest, you're going to bring $6,000 for the interest and $12,500 for the repairs. That's what you'll actually have to bring to closing. We roll everything else in. And then, of course, you get the $12,500 back once you get the repairs going. So that's a new product we're coming out with right now. It's the cheapest hard money, certainly in Minnesota, and it's also the cheapest money in Oklahoma City when you consider the fact that we're willing to work with you if you have a sub 700 credit score, which most flippers do, right? So that's my latest pitch.
All right. Well, I got about 20 questions, so let's just start off with mine. You say that you have to prepay the 6 months for the interest. What if I flip that deal in 3 months? Do I get that paid back?
Absolutely, prorated to the day.
Okay. I like this creative new program
Good.
where it's 12% interest, 2 points, and you still have to bring the repairs, and you allocate your inspector jives with my analysis of what those repair costs.
Precisely.
Okay.
Precisely, and only half the repairs.
Sure.
Because you need the other half to get started.
Right. So basically it just covers all, make sure there's no weirdness.
We know you're not going to bring half the repair money if you don't have the other half to start with. Right?
Okay.
So that's why we do that.
Any other questions before I start getting rolling? Anybody else?
You have a draw fee?
There is. For repair draws, historically, we charge $150 for our inspector to go out. So the other good side of that, though, is it's 100% financing. Yeah, you're bringing 6 months of interest in, but it's 100% financing. No lender does that other than us.
So 150 for each draw?
That's correct. So most customers do 2 draws, one when they're halfway done and one when they're totally done.
Mm-hmm.
Yeah. And it's always a good idea to meet the inspector out there so you guys jive on what's been completed.
Yeah, that was the question that I had is, who's this inspector? Is this someone that you've educated on real estate? Are they like a true engineer inspector that has some sort of a credentials? Or is this your homie on the side? Hey, go check that house out.
Honestly, it's more of a homie on the side, but he's a homie on the side who started the repair piece of Homevestors with Ken D'Angelo in the early days. He happens to be from Oklahoma City. So this guy knows his stuff backwards. He's not a licensed appraiser, but he does our comp work.
So how do you say like an inexperienced real estate investor says the repairs are only going to cost 15,
Right.
and your inspector gentleman says it's 25. There's a $10,000 discrepancy. I'm assuming this must happen.
Absolutely.
And how do you handle that situation?
Well, if it's grossly off, we may not make the loan because it's demonstrating that they don't know what they're talking about. But if it's close or within reason, or if they just didn't understand that we need the retail value of the repairs, not what you can get it done for, which is most often the case,
Yes.
we'll use our numbers.
Okay.
And that's how the loan has to be structured, using our loan.
Safe.
Because it's safe for us, but it's also, if you screw it up, we're going to have to pay that to fix it right.
Okay.
So that's the way we choose to look at it.
So when you're doing your estimation of repairs, just a rule of thumb, they are retail.
Yes, sir.
So if I call Joe Construction out of the phone book, $350 to install a door is what we're gonna budget for.
There you go. It's not quite that bad. But yes.
I just
Yes. No, you're
no
right.
landlord prices.
A hot water tank may be 900 instead of the 300 without a,
Yeah.
you know, there's all kinds of things. And we've been okay with that as long as the work has been done in a professional, workmanlike manner. We'll fund it. If you got it done for cheaper, good for you. Then you keep that portion
Sure,
of the draw.
you'll get it back.
No problem.
You
We just
mentioned
want the work done.
you mentioned 700 credit score. Just how important is credit? I mean, these terms seem more favorable for the lender.
Right.
Is there a lowest possible credit score, or is it really truly based on the asset itself?
So the two biggest components of that underwriting decision are how cheaply are you buying the property and what is your experience level. By far. Credit's a consideration, but way down the list.
So if you were a relatively inexperienced investor, you had a 700 or 675,
Yep.
and your debt to ratio seems okay because
Yes.
you'll figure that out real fast on their credit report.
Yes.
I can-
And Sandy in my office, she's the one you'll talk to when you call the office. It's Red Dirt Lending. She can answer all these questions for you, of course, better than I can, frankly. But she may decide that to recommend to me that we only do a 60% LTV with this customer.
Yeah, what is your typical
The
LTV?
maximum is 70% LTV. Sorry, I failed to mention that. Yeah. So
And for you that don't know, that's the loan. Explain the LTV to people.
loan to value. So let's say you have a $125,000 ARV after repaired value home, but it takes $25,000 to get it there. It needs $25,000 of retail repairs in order for it to be worth $125,000. We would call that a $100,000 as-is house, right? 125 less than 25 is 100,000, and we would loan a maximum of $70,000 on that house for acquisition. We were doing the repair draws where that would would start funding up above, but now we're just doing the acquisition, so that would be the piece.
So this is a typical whole new business model change.
It is.
Okay.
It's brand new.
Okay.
And nobody, I don't know, we may not get any business. I don't know. We'll see.
No, I'm just.
We
I'm
may go
fascinated.
back to the old way real quick.
So, like, what's your typical answer to say? Well, why would I want to use you when I can use a bank? I know
Just-
that's an aggressive question. People probably uneducated they ask that question,
Well,
but
the snarky retort to that is because we'll say yes in 5 days, the bank will say no in 45 days.
that's
Go
pretty
for
good.
it.
That's the truth. I could name a few of those banks for you. if you like.
Yeah, that's the big answer. But the other is stretching those dollars, right? Even if we have customers who have credit lines with banks, but they have 3 or 4 projects going, and then this hot deal comes along, and everyone knows how hard it is to find these things to start with, and you want to tie it up.
Sure.
You don't want to lose on the deal, so it makes sense to use hard money in that regard.
So it's a great tool.
Yeah,
Okay.
absolutely.
Anyone else? Any questions?
I have a question.
Yes.
How do you feel about people bringing you a credibility kit, show it before, after pictures, and their
It's a great idea.
credentials?
That all helps us with the experience part of the equation, which is the second biggest piece. Absolutely. Sandy will ask for that. What, HUDs, pictures, exactly. What properties you've been involved with. Did you make any money? Do you know what
Do
you
we ever make money?
Yeah. But,
Good question. Good. If you're new or starting out, a credibility kit is just like a resume of your skill set of what you've been doing in real estate. Maybe, and if you don't have a credibility kit per se, but you've been mentoring under someone, you may want to leverage that person's skills or their credibility kit and communicate that to the prospective lender.
Right. Great idea.
As far as the timeline of the process,
Yes, sir.
like from finding the property to closing, and then beyond that, you said most of your guys are flippers, but some are landlords.
Yes.
What does the timeline look like after that, as far as like if I'd be interested as a landlord. Acquiring the property and then refinancing later to get some of the money back.
Right. Of course, it depends entirely on the lender who's going to take us out, right?
Yeah.
Some lenders will be happy with you improving and tenanting the property in 3 months with 3 months seasoning. A 6-month product would be great for you. Some insist on a year, which now we have a 12-month product. You can use that. But we are not long-term lenders, so you've got to have that figured out because you don't want to get trapped.
So we really need a good system in place as far as, another bank to refinance it
Right.
as quickly as possible. Yeah.
Exactly, and then tell them exactly what you're doing. You're using Red Dirt Lending. Here's what I'm paying. I'm paying this a month, which is crazy. You got to help me. And they'll say, "Yeah, that is crazy. We can get you out of this,
Yeah.
or not.
Okay.
And if you can't, you just have to sell it."
Yeah. Yeah, for sure.
So,
So is your line of credit with institutions, private money?
so we have a $6 million line with the local bank. I've also done a private placement agreement, and from investors, I've raised a little over $3 million with that. And then just friends and family, I call it commercial paper. It's unsecured stuff, and maybe another $500,000 there or something.
You mentioned you've this roller coaster life. You had to start over. How'd you pick up the pieces and
Wow.
and push through? Even though you probably felt very, we all felt that way once in our life. What motivated you? How'd you keep starting over?
What motivated me was a wife and 2 kids in a big house.
Okay.
Keep in mind, we're spoiled kids.
So you
we
already
have a
had
very, very good lifestyle, which demands that we continue it. And so I was highly motivated to figure it out. But I will tell you, since you asked, have you ever heard of landmark education? Anyone? Okay, well, it's a evolution of the old Est of the 70s with the guy who beats you up, Remember those programs? And I was a frazzled mess taking Lexapro and, not good. A customer in Minnesota said, "You've got to go to this landmark forum." That's the initial program. It's a weekend deal, and they get you thinking differently. And that's really the impetus for. As a result, they make you write down, what do you want to get out of this class? And I said, I want to be able to tell my family. It was 1998, 2007, I guess, where I went to our family board and said, if we don't do X, I'm leaving all the family companies January 1st of this date. And that course gave me the gumption to do that. And shockingly, it happened. It's one of those, you set a goal and
Sure.
by God, I'm going to hit it.
And it works. I know that for a fact.
All your thinking changes to achieving that goal, and it worked. I couldn't believe it. I thought I would be cut off and in the gutter. I was really taking a risk for my family and everything. But also, there's some ugliness with the family business
Sure.
stuff that went on too.
Do you have safety measures now? Is there so we don't spiral into that?
I'm in a good place right now. However, that immediately takes me. Does anybody see Jerry Jones on 60 Minutes like a couple years ago? And they said, "What drives you, man? What is your deal?" And they're having this interview on his Gulfstream airplane, by the way. And he says, "Man, I feel like every day someone can take it all away." And that's what drives me, and I'm the same way. I'm in a good spot right now, but I can see a scenario whereby I'd be in real trouble. Really,
Donald Trump.
Yeah, right,
I'm just
right.
I'm just teasing.
But no, I still, on a personal basis, I still owe my dad money, as most of his children do. And now he's made real good money on Red Dirt, but formally in a note situation, I'm still not out of the soup. I mean, I was in a bad spot about 5 years ago.
Cool. Well, we're glad you're here in front of us. So, all right, any other questions anybody has?
How often do you have to take a property over that somebody just...
It's about 5% of the time. I would say, 25% of the loans get into trouble, what I call trouble. That is where they go beyond that magic 6 month date. I consider a loan in trouble after that. If you're not designing your business as a flipper to get in and out in 6 months, you really shouldn't be flipping houses, right? Many of them get into that category. And it used to be we'd start charging double interest starting month 7. Now we're doing this 12-month program, which is one of the only things that concerns me about the new program because it lets you get into trouble easier. However, I'm quite certain that forcing you to bring half the repair money will motivate you to get the repairs going, right?
Sure.
That's the reason for that.
Anyone else? Question?
What do you do with the houses that you've taken?
Lease option fleet. I love it. Great
Yeah,
strategy.
explain your lease option program.
Well, gosh, it would take a long time, but in essence, we discovered that there's a whole subculture of people out there who not only want to do a lease option, but are willing to do the repairs and maintain it. Right?
It's gold.
So, yeah, that's what we want to do, and they love it.
Is
And
that
they love
your
it.
business model besides the red dirt lending? Is like
Correct.
lease option, and
Especially since I found this Texas investor who wants to do a bunch of them.
but they have to buy them in a legal entity
Well, that's true. Yeah.
because
Now-
of the Dodd-Frank, I'm assuming.
Yes, exactly. Now, keep in mind, I'm not providing a turnkey product for investors, but for that one
Sure.
Texas investor who actually basically bought an exclusive arrangement from me until he gets tired.
Okay.
I want to keep him happy. So, did that answer your question?
Well, does everybody understand what a lease option is? Basically, it's like a wraparound mortgage per se. You have a property. You may have it a loan or leveraged, and it's irrelevant to the point. And the potential buyer or the buyer buys the property with a certain amount of money down, what you deem necessary, and then they're paying you. Usually, this property is not in a condition. It may need some repairs, and to the tune of $15,000-$20,000. They're paying you a payment, and then you're either paying your debt that you have on it, and you're keeping the middle, the spread. And then it's a lease purchase, so there's a certain percentage going towards the lease and certain going to the purchase, or is it a complete purchase?
No, it's an option. We don't let the monthly payment go towards the purchase because that's where you cross the line again.
Yeah.
To
So basically,
installment
they're
sale. It's
renting
not an
it-
installment sale.
So they're renting it to fix it up, and then whenever they're ready to cash out, hopefully 30 years from now, that price would stay. That's the word option. It just stays to that price.
Right.
And then whenever they show up with that amount of money, they get the property debt free.
And we help them. We help them get to the mortgage lender and get cashed out. We love it when they do. We make a good spread on the end when they do. Actually, it's better if they don't and we just do it again, right? But
Well.
if someone gets in there and jumps through the hoops and does everything they're supposed to do, we love it when they buy. It's great. And they love it. And there's a couple things that you'd want to do if you were going to do what we are doing to not be predatory, because it's also easy to be predatory. Most people will sign anything. And so you got to be careful. And one thing we do is send them through a screening company to see just how far away from mortgage ready they are. So we'll send this company on the East Coast, screens them for us and says, Fred, we'll be mortgage ready in 9 months. He's got to raise his credit score 30 points. If he wants to sign up with us, he can do it, or someone else, he can do it. His debt to income ratio is a little out of whack. You got to do this. He doesn't have 3 years tax returns because he's self-employed. All kinds of reasons that you can't be mortgage ready today, but time will solve. And that's what we do. We rarely go beyond 3 years. All right, it's the option period. Because if you can't fix what your problem is in 3 years, then you're probably not going to buy it anyway.
And then it would
So-
be a lot of legal issues with the Dodd-Frank.
Yes, the other thing we do to not be predatory is we don't make them do major repairs. We make sure that roof, heat and air, plumbing, electrical, foundation are good because they can't handle those big ticket items. But cosmetic, knock yourself out, go buy paint and tile, and which is a lot of money.
Scott, I love your approach of having a third party pre-qualified, not pre-qualified them per se, but if you ever got in a legal battle,
Right.
that would definitely be great data to present at a hearing. The lease options can go wonderful, or they can go quickly against you, and it hinges on the judge and how they feel that day. But if you have that item,
Right.
that, hey, we vetted this person out. Our goal is to sell them the property. They're unable because they don't have a good credit score at this time, or they're in transition. But we've done all our due diligence. For me, that was worth the
It
breakfast.
seems your approach prevents a foreclosure, so you would have an eviction, you wouldn't have a foreclosure.
Correct.
Your approach.
It's an option. If they want to
Yeah.
perform, they can. If they don't, they don't.
That's
And they
it.
love that. Because a lot of people decide for whatever life reason, 10 months later, I don't want to buy this house.
There's no loss.
Yeah.
What's
Great.
your normal options be?
Whatever they got. We actually don't publish that. And here's the reason. There's a selfish reason for that, which is why you laugh. But there's also a reason that we do that is to tailor it to them. We really want them to buy. Some people have more cash to put down than a monthly payment to pay. Some people would rather pay a much higher monthly rent, rather, not a payment, a rent, and a low deposit. You know, it just depends on their situation. Again, the goal is to get them mortgage ready and get them to buy the house. Every case is different. So we've just decided we'll publish the price and then see what you got to work with, and we'll tailor it to you.
Excellent. Any questions?
What's the length of your options?
Anywhere from 1 to 3 years.
Pretty short.
Yes, sir.
What's the terms you usually offer? Like, is a AM'd over a 30?
There's no AM.
No,
It's
I-
no
Well, did you
installment.
just come up with a number? I mean, but how do you come up
Market rent, rent to meter.
with? Okay. Market rent.
That's what we
I mean, I
said.
struggle with that. One question is like,
Yeah.
because I want to, because I have a mortgage on a 10, usually.
So what we say, because we want to know more what they got to work with than what the market is, we say it's negotiable, but a good place to start is Renometer,
Sure.
which is always close to market.
Anyone? We're going to wrap this up. Anyone else have a dynamic last question that can beat mine?
If you get a higher than market rent,
Yes, sir.
that could be construed as being predatory, could it not? I mean, is Dodd-Frank going to be looking at that pretty strongly on people?
You know what? If it's radically higher,
$1,000 on $800,
yeah,
they're going to say baloney is
Yes, sure.
actually a financing deal.
you're right. It could actually even lead to difficulty in getting the loan.
But
You're
you
right.
might get an 825.
Right.
Yeah.
You got it. You got it.
Anyone else? Okay. How about your goals? Where are we at? 2017 came from the mire. You're heading in the right direction.
So,
Own the world. Tell us about
no, survival is one.
it. Everybody, write that down. Survival. Please write that down.
Good bottom line there, survival.
That's okay.
It's a baseline.
Hey, it's a start for some folks. Breathing is a good goal.
That's right. That much I know. So much of it depends on this Texas investor. Do I perform? Do I keep him happy? Is he going to keep the money flowing? I mean, this is a guy who dropped $1 million on bank accounts and go buy houses. And I'll put more in if I'm happy. So I'm obviously motivated to do that. If he stays in place, my goal is to buy 50 houses, calendar
For yourself?
17. Well, for this, yes,
And well, you have a percentage of that.
exactly.
Okay.
Exactly.
This last question I forgot to ask earlier. You have some lines of credit, local bank. How do you have those collateralized somehow?
So they use the subject property as collateral for the loan.
Oh, even better.
Yeah, they're
So
first
it's just-
mortgage condition.
That's awesome.
Mortgage position.
So it's just this is fake money that sits there,
Kinda.
and someone brings you a house.
Yeah.
You do all the pre-qualification.
Yeah.
Run them through the ringer.
Yeah.
And then I need that deal.
there's an advance rate, so I have to come up with a portion of it, but I have investors who fill that gap for me.
Absolutely.
That's how.
That's
So
a
where are
great
you looking
merit.
at houses, just here in the city? Or are you
So
looking
yeah,
at surrounding area?
anywhere in the Oklahoma City metro area, if anyone has houses to sell.
And what kind of price range are you talking?
You know what? The lease option model lends itself most well to the lower blue collar neighborhoods. I don't mind poor. I do mind no pride of ownership. In other words, don't want war zones. I don't want boarded ups, vacant lots, graffiti. But I can get down pretty low. Most of our purchases are in the $40,000 to $80,000 purchase price. So that's what, 100 to 150 ARV, 120 ARV really. So I don't really like two beds or houses under 900 square feet. Yeah, anywhere in town's good except a war zone. Southeast, some rough parts, obviously.
Yeah.
So how could someone get a loan? How do they contact you, or what's the best way to get a loan?
RedDirtLending.com. Call the number.
RedDirtLending.com.
Call. Ask for Sandy. Sandy's your
All right.
best friend. I'll screw it up if you talk to me.
Well, put your hands together for Scott McLean. We appreciate your time.
Thanks for listening to the Savvy Radio Show. Glide online and listen to our other motivating episodes at SavvyRadioShow.com. Connect on Twitter at LandlordBook and always be buying assets.